Today, household financial confidence tanks again, but are investors back? Hello again, I'm Martin North, the Principal Analyst of Digital Finance Analytics. Welcome to the latest post covering finance and property news with a distinctively Australian flavour. Today I want to discuss the latest in our Household Financial Confidence series. This is starting to look serious, as the latest Household Financial Confidence Index results for January 2019 reveals a further decline in the levels of confidence. The index fell from 87 in January, down from 87.3 in December, and that's the lowest it's been since the survey commenced, well below the neutral setting of 100. And by the way, by way of background, these results are derived from our household surveys, averaged across Australia. We have 52,000 households in our sample at any one time, and we include detailed questions covering various aspects of a household's financial footprint. The index measures how households are feeling about their financial health. To calculate the index, we ask questions which cover several different dimensions. We start by asking households how confident they're feeling about their job security, whether their real income has risen or fallen in the past year, their view of their costs of living over the same period, whether they've increased their loans and other outstanding debts, including credit cards, and whether they're saving more than last year. Finally, we ask about their overall change in net worth over the past 12 months, and by net worth, we mean the assets less outstanding debts. Looking at the results by property segment, we see a fall in confidence among property investors as home prices and rental yields continue to fall, and also reflects concerns about potential changes to negative gearing and capital gains ahead. Purchase interest has risen a little, and we'll discuss this later. Owner-occupied borrowers are also feeling the heat, reflecting the same mortgage pain price, as well as the basic affordability issues. Those renting, however, are a little more positive, relatively speaking, thanks to rents being lower now and a greater choice of property for rent being available, especially in Sydney. Overall, investors are the least confident now, a considerable switch from a year or so ago. Cutting the data by states, we see that the bunching continues as property price falls in Sydney and Melbourne erode confidence there relative to the other states. And the most significant fall was indeed in New South Wales as home prices fall, and the fallout from Opal Tower had an impact more broadly on those who purchased recently from new and also off-the-plan commitments. Across the age ranges, we continue to see weakness, with younger households more exposed, although those older households with share market investments saw a rebound in January, which boosted their confidence a little. Turning to our wealth segments, we continue to see property owners without a mortgage the most confident, though falling close to the long-term neutral benchmark, while those with mortgages, either investment or owner-occupied, continue to decline. Renters remain the least confident. This could become an important indicator in the run-up to the next election, in that even those heartland voters supporting the incumbent government are less positive than usual. And we can then examine the moving parts within the index. We start with job confidence. Those feeling more secure about their job prospects fell 2.19% to 10.57%, while those feeling less confident rose 4.84% to 3.85%. 51.68% saw no change, but that fell by 3.30%. There was a noticeable rise in concerns in the construction sector as building approval momentum falls. Savings rates continue to fall for many, and others are raiding what savings they have to maintain their lifestyles, something which of course cannot continue indefinitely. One reason why the savings ratio continues to fall. In fact, just 1.98% of households were more comfortable than a year ago, down 1.28%, while 48.96% were less comfortable, a rise of 2.52%, and 46.24% were about the same, down 1.56%. Turning to debt, 1.11% of households were more comfortable than a year ago, and 52% are about the same. But 46% are less comfortable than a year back, thanks to rising rates, switches to interest and principal from interest-only loans, and problems in servicing the debt repayments. We also continue to see growth in quasi-credit such as Afterpay, as well as other forms of short-term credit. And household debt, of course, continues to rise faster than incomes or inflation. Income growth remains a real concern for many households. In real terms, many have seen falls in recent years. 3.88% of households reported their real income had fallen in the past year. 51.99% said incomes had fallen in real terms, and 42.5% said there had been no change. We continue to observe pressure on the income side of household balance sheets, despite the RBA's expectation that wages will rise eventually. One bright spot was dividend payments, which were higher, but this failed to offset the total picture. One of the killer categories is the cost of living. Once again, we think the CPI figures do not reflect the lived experience of many households. 87.85% said that their costs had risen over the past year, up 3.2%. This includes the old favourites of electricity, childcare, healthcare, and household staples, despite a fall in costs of fuel at the bowser. And finally, household net worth continues to take a dive, thanks to falling home prices. This despite recent positive share price moves. Overall, 32.81% of households said that their net worth had improved, down 1.82% from last month. 37.28% said that their net worth had fallen, up 4.05%, and 27.42% said there had been no change, which was down 2.5%. One other interesting point which came out from the analysis is that potential property investors are more active now thanks to the falls in asking prices and, importantly, the burning fuse with regard to ending negative gearing should Labour win the next election. Thus, we've seen a rise in investors considering transacting, and some lenders are offering special fixed-rate offers in the light of APRA's hands-off approach. And of course, Hayne did not do anything on responsible lending. The tighter underwriting standards are still in play, of course, for now, but I would not be surprised to see a kick-up in new investor lending in the weeks ahead, despite the lower levels of financial confidence. So in summary then, interesting times as household finances are squeezed, yet the fixation on property for many Australians remains strong. There is still a belief that falls will be limited and they will bounce back. We, of course, are not so sure. And we're going to update the index again next month. And before I go, a reminder that our next live stream event is now scheduled for Tuesday the 19th of February at 8 p.m. Sydney time. Here is the link to the reminder. And you can ask a question live or send them to me beforehand, and I look forward to seeing you there. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.